Hiya, this is Thinking Solo. I'm Ryan DeRusso, a fee-only financial planner. Today, we're going to dig into 6 tactics you can take to improve your chances of financial independence. I know that many therapists, solo practitioners, and the like love what they do. They cannot imagine ever retiring. Whether that's the case for you, it's important to realize that while you may want to work forever, you don't want to be forced to work forever. Not only that, but there are ways you can use long term investing tactics to improve your cash flow today. That's really the importance of financial independence because you're not striving for it, then you're not likely going to find the best possible ways to manage your finances. That's why we'll dig into 6 things to think about as you set on that journey or continue with your long term goals. But first, hit that subscribe button. Now let's get started. Financial independence means different things to different people. But for me, I'm talking about getting to the point where you no longer have to work. You could quit tomorrow and live off your portfolio or an income stream for the rest of your life. To reach this point fast, you have to save fast. That means increasing your savings rate from how you manage things today. Depending on how serious you are about FI, then it can dictate how much you need to save. If you want to reach it in the next 10 or so years, you have to increase the amount you have to save to over 50% of your income in all likelihood. But if you have a longer time frame in mind, then 20% or 30% will certainly suffice. It can be smaller depending on how much you spend and how long you have. As a starting point, I suggest aiming for 25%. If you find that works for you, then great. If it's too much, you can pull back a bit. If it's easy, then you consider saving more. The question then inevitably follows with that is how can you save such rates? It's a very important question and completely understand. It's a very individual question. In some cases, it requires cutting back on things that a person likes but doesn't need. In other cases, there's the simple act of taking tax advantage steps to save more aggressively. While I'll talk about what you can do from a tax perspective shortly, from a spending perspective, it requires taking a fine-tooth comb to how you spend, what you spend on, or where the money goes, and determining if that's worthwhile or holding you back from your financial independence goals. You've probably heard that when investing, you should diversify your investments. That's of course true. You want to use low-cost index funds to capture the entire market in most cases. But for financial independence, you should also consider what types of tools you are funneling investments into. There are 3 big buckets that someone seeking FI will want to focus on. One is the tax-deferred accounts. These are like your solo 401k or a regular IRA. 2 is your tax-advantaged accounts, like a Roth IRA or even potentially a Roth 401k. And 3 is a brokerage account, which is where you store non-retirement investments, even if they're for retirement. Why would you want diversification among these tools? It's simple. They serve very different needs. The tax-deferred accounts, like the solo 401k, allows you to increase your savings in a tool that you don't have to pay taxes on the income today, nor do you have to pay on the funds as they grow. It's only when you're distributing the funds that you pay taxes as if it's income. But you will pay penalties if you remove funds from the account before you're 59 and a half. This differs from the tax advantage accounts, like the Roth. Since a Roth, you pay taxes today, but you don't pay taxes when you're distributing the funds. Plus, they have rules about accessing the funds, which I will get into shortly. Then the brokerage account provides access to funds at any time, and there's some tax advantages to them, which we will also discuss shortly. As you can see, these can serve different purposes. What if your goal is to retire or reach financial independence by 50, and then you plan to take 3 years off before restarting your practice again? Well, the funds in the tax-deferred accounts may not help you, but you could potentially access the brokerage accounts to fund your lifestyle during that time. This requires analysis, but understanding where every dollar will come from, no matter your goals, will set you up for success. And the more options you have, the more flexibility it will provide. Tax-deferred savings tools like the 401k are an important part of the savings process, partly because they provide so much value in tax deferral today. Why is that important? It's possible that you're paying more in taxes now than you will ever in your life. Why? because you're theoretically making more now than you ever will in the future. If that's true, it's better to cut the higher rate today by not paying taxes on certain funds and delaying the tax when you take out distributions later in life. Here's the most common tool. Here are the most common tools to invest are in the solo 401k or SEP IRA. I've recently created a video on deciding between those, which I've linked below, and you can access it there. What's important for this conversation is that you're not taxed on the income that you put into the solo 401k up to $22,500 this year. That can cut your tax liability by thousands depending on your income. This creates room for you in other areas of your life, whether it's more cash flow or more additional funds to save. Meanwhile, you're stashing funds into an account that you can invest and grow long term. The problem? You can't remove these funds without taking a Roth conversion or suffering a penalty once they are in there, unless you're over 59 and a half. If you hope to access these funds sooner, then you also need a plan for other areas of your life. Now for the Roths. This may or may not matter to you. For those with income above certain marks, then you cannot directly invest in a Roth IRA. But in a solo 401k or a company plan, there's the possibility of allowing for Roth contributions. In that case, the money can be added to the accounts no matter your income. This money is taxed in the year you receive it as income. So if you're in the 24% bracket, it's taxed on that marginal rate. The value of these funds is the ability to grow tax-free and be distributed tax-free when you're ready to use them. This allows you to have a large bundle of income that you never have to pay taxes on again, no matter how large it grows. There's another benefit to the Roth IRA in that you can access the funds potentially a little earlier. First, any contributions to a Roth can be withdrawn at any time tax-free. This means the money you put in, you can take out. It's a valuable thing in a case of emergency or something similar. The second wrinkle is that Roths have a 5-year rule. I'm not going too deeply on this here, but essentially it means that any earnings the Roth contributions earn can be taken out as long as it comes 5 years after the initial contribution. This allows you to time withdrawals if you're wanting a source of income for a period of years. Say you want to continue working, but at 50 you only want to work part-time. You can use the Roth accounts to time distributions each year, providing you with 50% of your income, and it's all tax-free. This can be done if you're keeping in line with the 5-year rule. I would say, by and large, the account that those seeking financial independence or even retirement ignore the most is the brokerage account. And it's easy to see why. You have to pay taxes on the money as soon as you receive it. If your investments earn dividends or buy back stock or you sell a holding, you have to pay taxes on it that year. And when you withdraw funds, you have to pay taxes on the withdrawal for the most part. But there's an important wrinkle in the last point, which many people overlook. It's the fact that capital gains are taxed at 0%, 15%, or 20%. Now, what people overlook is the mark where they're taxed at 0%. For someone married filing jointly, they can actually remove under $83,351 of gains from the account and not pay a single dime of taxes on the amount if they have no other income that year. You have to make sure you have no other form of capital gains or income in such a case, of course, but this provides a valuable resource to access withdrawals tax-free, or it limits taxes if withdrawing more. Let's take the therapist that wants to take a few years off at age 50. Let's say she needs $100,000 and her spouse has no income in the year. This requires withdrawing $100,000. This therapist can actually do this through a mix of withdrawing from the brokerage account and withdrawing from the Roth account, or withdrawing from the brokerage account using a mix of gains and contributions. If they are truly financially independent, then it allows for the other parts of both accounts, along with the tax-deferred account, to continue to grow while very little taxes are paid on the funds, maybe none at all. Beyond looking at your savings, investing with a tax lend, I would also recommend coming up with a plan for your business if you end up deciding you want to step away at some point. Too often, those self-employed or in private or small group practice do not view the practice as an asset. This is ignoring one of the most important assets at their disposal. Taking steps now to ensure you can sell the practice if you ever wanted, then you can be ready if that time arises. More importantly, it provides a potential buffer to your planning, since you're not ignoring one of the most important assets you have at your disposal. Are you planning for financial independence or retirement? Which one and why? Let me know in the comments below. Make sure to like and subscribe. This is Thinking Solo, and I'll see you next time.